Good evening, good morning, good night, ladies and gentlemen, wherever you may be listening and watching the Irv Homer Show. Welcome to Wednesday, January the 21st, 2009. We have a new president. I haven't spoken to you since the last administration. We'll get into that probably on Friday night. But because of the questions that have come up from having Pearl Polto on about credit, questions about mortgages, where we sit at the present time with the mortgage industry. What questions do you have for the first-time home buyer? Refinancing your present mortgage. All of those questions have been coming in on my email and on the chat room. And so I figured the best thing to do is to get someone on the air who knows something about mortgages. And in a few moments, we'll introduce you to Mr. John McCarthy of American Independence Mortgage, who handles commercial mortgages, residential mortgages, first-time home buyers, investment properties. Get your questions ready, ladies and gentlemen, for the mortgage program on the Irv Homer Show tonight. Let me thank my son for doing a show on Monday night. I was busy trying to get some knowledge about the election and the inauguration and the big ball in Washington. We'll comment that on Friday night when we have an open forum. Before we go any further, those are two questions we want to answer.
Yes.
First, we have some questions, John. If you'll please give me a few minutes to respond to this question. Irv, longtime listener, the president-elect said he would eliminate federal taxes for people over 65 with an income less than $35,000 a year. What can you tell me about this? T.R. Dites. Well, I guess I can't tell you anything about it because it's a suggestion that's been made during his campaign, and of course when the president wants to make changes in the tax law, he must of course get the approval of the Internal Revenue Service, the Federal Reserve Bank, and the Congress. So a lot of the proposals sound good, but don't count on it until the chicken lays the egg. Our second question is, it just came to me that with this new administration, the New World Order might be pushed through more rapidly. If so, those other countries that make up the ruling class might say to us, you can't have your political holidays like the 4th of July, President's Day, Veterans Day, maybe even Easter, Xmas, and Thanksgiving being those days or money or political days in a way. All the countries in the whole world will have to have the same holidays and no country will be special. What do you think, Bob? I think you've been drinking funny water. If you think for 1 minute countries are going to give up their national holidays or celebrate their individual celebratory days to have all the sales they have, it just ain't going to happen. The world order allegedly is for two purposes. Number one, to expedite the transfer of money. Number two, the world order is to create one international currency so that every time you do business outside the continental limits of the United States, you don't have to worry about the currency exchange for that day, for that minute. Money changes more than you change your underwear. So if you think that the world of 168 nations are ever going to have one currency, one language, one holiday, stop drinking that funny water. So those are the answers to our two questions. Before we go any further, we have a star right here in the Irv Homer household. Where are you, pup? Get her over here. We have a request for people to see what my dog looks like. This is the terror that keeps barking. Now look at the camera, dummy, and you can be a star now. See that? Now when you hear a bark in the background, this is what is barking, ladies and gentlemen. Now, you satisfied now that you became a star on the radio and television? Okay, get lost now. Okay, now we've accomplished all of our pre-programming, and now we'll get to John McCarthy. John McCarthy, thanks for giving us some time this evening.
Thank you, Irv.
John is with the American Independence Mortgage Company. Been in business for how many years you been doing this, John?
I've been doing it for about 5 years now.
Okay. And in 5 years, you came into the business at the right time, didn't you?
Yeah. Back then, 5 years ago, things were humming pretty well. Yeah.
And what do you? Let's get to some specifics on the mortgage business. What happened, in your opinion, John McCarthy, on this whole bailout, this whole prime rate, this whole thing that blew up and we're going into uncharted waters, and you have as much time as you want to take.
Well, it kind of started, a lot of people don't realize a lot of it started in the Clinton administration when they did not intend it to turn out this way, but they tried to make homes more affordable for people, for the general public. And so the types of mortgages that were available became, the requirements became looser and looser until at one point you could get a mortgage without proving your income. You could, no income requirements whatsoever, 100% financing, no money down.
Now, is that what they consider to be those no-doc loans, no documentation necessary?
That is correct. That is correct. And you didn't even really, your credit score could be in the 500s to be eligible for that type of loan. That was just 2 years ago.
Well, didn't the mortgage companies, John, realize what they were doing, or was there that much money available that they just threw it out indiscriminately?
Well, I'm a little bit biased because I'm in the sales end of things.
Sure.
I personally try to, look at things where, tell people I don't think you can afford this mortgage, even though the law would allow them to get the mortgage. There was a lot of mortgage lenders out there who would say, look, the law is what it is. I'm allowed to do this, so I'm just going to go do it, and whatever happens, happens. I'm going to take my profit, and I'm going to roll with it.
But the original concept, I suppose, John McCarthy, is a good idea, that we believe in home ownership in America. The ultimate goal is to have that little house with a picket fence around it, have the dog running around barking at the mailman as he goes by. So the original intent was a good idea, was it not?
Absolutely.
And then it just went to the extreme of saying, hey, anybody can get a mortgage. Did they have to prove they had a job?
Actually, all you had to do was have somebody at the other end of the phone and answer the phone and acknowledge that that individual worked at that other end of the phone line. That's basically all you had to do.
So it was legalized identity theft.
Pretty much, yeah. Yep.
Has the rules of mortgages today tightened up a little bit, John McCarthy?
Absolutely, absolutely. It's gone from one extreme to the other, where people who have tremendously good credit, great jobs, great income, not a speck on their credit, no credit problems whatsoever, they're getting put through the ringer now to prove that they are credit worthy for a mortgage. Now, there are some, I was watching your broadcast with Pearl before I got on tonight, and she mentioned a lot of the things you hear in the media are really stretched out of shape, and that happens in our industry as well, where if you do have good credit, and even if you don't have great credit, there's still mortgages out there where you only have to put 3% down. It's just getting the actual mortgage, getting approved for the mortgage, is a process where you're going to be looked at very closely in terms of your credit worthiness.
Now, one of the things, excuse me, John,
Mm-hmm.
one of the things we hear about is refinancing. A lot of folks have mortgages and the interest rate is more than they feel that they can afford. How does one go about refinancing? If I would call John McCarthy and say, John, and American Independence Mortgage Company's number is 610-388-9788. If I would call John McCarthy at American Independence, I would say, John, I got 15 years left on my mortgage, and I think I'm paying too much interest. What would I do?
Yeah, the first thing we would do for you, Irv, is try to determine how much equity you have in your property. You have to have a certain amount of equity there to be able to even begin the process. And then once we determine you have the equity, then we go to your credit. So we have to find that your credit is good enough, or high enough, I should say. Your score is high enough for you to get a mortgage rate that makes sense for you to refinance.
Now, one of the things that drove me crazy was that the person had the bad credit had to pay more interest on the mortgage than the guy with the good credit. Well, he had bad credit and he couldn't make the payment. Why did they jack up more interest on his mortgage?
Yeah, it was, really was what brought down everything, was that ability for those people to get the cash out or get the mortgage. What they were doing was they would get a 2-year adjustable rate mortgage. So the rate was fixed for 2 years. And it would be at a pretty high rate of interest, but they figured, in 2 years when the rate adjusts, I'll just refinance back into another 2-year adjustable rate mortgage. But what happened was, the proverbial crap hit the fan, and then the music stopped, and people were not able to get into that 2-year adjustable rate mortgage anymore because those products went away.
Right, John. John, is it possible to lower your computer? We're getting a little feedback.
Yeah, sure.
Okay, please do.
Let me just turn it. Actually, I don't even have the sound on.
Oh.
Let me just turn it.
Yeah, that's a lot better.
Let me just get out of the website altogether, just in case.
Okay, great. We have some questions. If you have any questions about your mortgage or about the mortgage industry or how you can get a mortgage, how you can refinance one, if you're a first-time home buyer, maybe John McCarthy of American Independence Mortgage can answer your question for you, save you a lot of trouble, a lot of aggravation. You just get on our chat room. We won't take any phone calls because John is on the line, and we'll be more than glad to answer your questions for you. Once again, we're brought to you by broadcasting from irvhomer.com. My website, once again, is www.irvhomer.com, and you can email me at evilerv@irvhomer.com. I want to thank Ron for sitting in the other night for doing his computer program, and he seems to be getting a lot of hits on it, so it will be a program to look forward to in the future when Ron decides to do his computer program. John, how are we doing now?
Good.
Okay, great.
Okay? Mm-hmm.
Yep.
We have a comment here on our chat room, John, and
Okay.
more or less of a statement. The mortgage companies were mandated by law to allow people with poor credit and low income to gain access to these types of loans or face stiff financial penalties instituted during the Clinton administration. You had mentioned that. You mean to tell me that if you refuse to give a mortgage with poor credit and low income to a person that you had no idea whether they could make it, you were subject to penalties?
Actually, I wouldn't go that far. There were certainly laws that were in place that would say you cannot discriminate, and the requirements, the eligibility requirements, were very, very low. They did have a floor to those requirements. I mean, you couldn't have claimed bankruptcy the year before, or have no credit scores whatsoever. But you'd have to be really, really in bad credit situation to not be able to get a mortgage 2 years ago.
Now, in light of the fact that mortgage, one of the things that I found disturbing when I took my first mortgage was, and I learned afterward, that the mortgage company sold my mortgage to another company after 5 years. Mm-hmm. And when I got notice, I said, "Who are you people? I don't know who you are. I didn't enter into any contractual agreement with you people."
Yep.
Now, is that a common practice where you'll get a mortgage, say, from mortgage company A, and 5 years from now you'll end up with paying mortgage company B? I don't know those people. Is that a standard?
It is, and it's still a practice that occurs today, and I'm not aware of anything any legislation that's prepared to change that. These these mortgages are considered market securities. So they're bundled up and sold in packages to various investors, and so you could have a mortgage with one company and it could be sold that day, the day of your settlement. That mortgage can be sold to another servicing company. So it can be sold multiple times during the course of while you hold that mortgage.
Now, what would be the advantage or disadvantage to the person who takes the mortgage?
To the investor who takes the mortgage, or the servicing company?
Yeah, what advantage it would be to me as the person who gets the mortgage if the mortgage company sold it to another mortgage company?
There's really no advantage at all, none whatsoever. And if you're with a good company that you like, it could be a disadvantage. If you're with a company that you're not happy with their service, it could be an advantage. So it depends on who begins servicing your mortgage.
Now, can I, if I get a mortgage, say from mortgage company A, say, look, under no circumstances do I give you permission to sell this debt to anybody else, or I don't want you to give me a mortgage?
In most cases, there's very few mortgage companies out there who will give you that guarantee up front. Very few. You can find it. You can find it. There are people who will guarantee it up front to say you will be with this X company, mortgage company X, throughout while you hold the mortgage. But it's very rare. But it can be done usually in the retail side of things.
I see. We're speaking with John McCarthy, ladies and gentlemen, of American Independence Mortgage. Their telephone number, if you're interested in doing business with them, and I suggest that you're dealing with John McCarthy, who I know personally have the utmost trust in. Their phone number is 610-388-9788, 610-388-9788. Some advice, John, for the first-time home buyer. Kids get married, they want to buy a home, maybe they got 10% down. How do they... Well, there used to be a standard rule of thumb, I remember, that your monthly payment should not be more than 1 week's income. Does that still hold true today?
Generally, there's the side where the borrower has a number that they feel comfortable with, and then there's the other side that where the mortgage company has certain fixed numbers that they use as a barometer to determine your eligibility. And generally the rule of thumb is that 35% of your gross income, no more than 35% of your gross income should go to your mortgage, and your total debt shouldn't exceed 50% of your gross income. That's your total debt, including mortgages, credit cards, student loans, that sort of thing.
Now, when you apply for a mortgage today, are you required to reveal how much you owe with a credit card debt, student loan, or anything?
Only what's reported on your credit report. And the things that show up on your credit report would be student loans, credit card debt, any mortgages that you have, car payments, and then the only really other thing that would be included that's not on your credit report would be child support, which is usually almost always revealed when you have to provide your pay stubs. There's no more no-doc loans. Everybody has to prove their income today.
Now, what about the VA loans, John McCarthy? Are they still available for veterans? And what's the rules on those things? And do you handle them?
VA, yes, we do. We do VA loans,
right?
And they're a great tool for the veteran to utilize. It's even better than an FHA loan because with Veterans Administration loans, you do not have to pay a monthly, what's called PMI insurance. That's a monthly fee that typically people have to pay when they put less than 20% down on their mortgage, or they have 20%, less than 20% equity in their home. So it's no money down, no mortgage insurance, and the seller can pay as much as 6% of the sales price towards the closing costs. So essentially, in theory, the veteran can buy a home with no money down and no settlement costs.
And that's a one-time deal, though, right?
It is a one-time deal, correct.
Right. We have a comment on our chat room. Every time these securities were resold, a new credit rating determined by the new entity holding the security, usually with an upgrade masking the real previous rating, therefore causing the bubble. What do you think about that comment, John?
Can you read that to me again, Irv?
Every time these securities are resold, a new credit rating determined by the new entity holding that security, usually with an upgrade, masking the real previous rating, therefore causing the bubble. I don't quite understand it, but I think I do. I think what there's basically, you try to explain, John, then I'll review it.
Yeah, that's a little bit above my level of expertise, but it has to do with the selling and reselling of these mortgage-backed securities, which is well beyond my expertise. And it's in the secondary market of mortgage-backed securities. That's not my expertise.
In the thing of commercial real estate, or suppose I want to buy 4 apartment units, is there a different modus operandi for buying investment property as there is for buying residential real estate, John McCarthy?
Yes, residential real estate investment. If you go take a conventional mortgage for an investment property, that would be going through Fannie Mae or Freddie Mac. They're the conventional mortgage people. If you're not going to live in the property, it's going to be considered an investment property, and you'll have to put at least 25% down. At least 25% down. With FHA, you can buy a multi-unit home, up to four units. You have to live in one of them, but you can put as little as 3% down on the property as long as you're living in one of those 4 units, and then you can rent out the other 3. Commercial properties are usually considered buildings with units of 5 or more. And commercial is tough because it's just the credit crunch has affected these commercial properties more than residential. So you've got to put at least 20% down. And they want to look at the books very carefully of how you're gonna make this whole situation work.
Now we're speaking with John McCarthy. If you have any questions about the mortgage industry, please feel free to get on our chat room. John, what is the whole deal with mortgage companies, and what are points?
Sure.
What are points?
Points are whatever your mortgage amount is going to be. If, say, for instance, you're buying a home for $100,000, good luck there. But you're buying a home for $100,000. You're putting 20% down, and you're left with a mortgage of $80,000. You can use a point to buy down the interest rate. Now, a point would be 1% of the financed amount. So if you're financing $80,000, 1 point would be $800. So I can pay points, 1 or 2 or 3 or even 4, to take my interest rate. Say I started out at 5.5%. I can pay those points to bring down my interest rate. I'm buying down the rate, as we call it.
Now,
Yep.
I remember when I was working, and the gentleman that preceded me on the air talked about something called halftime, that you make payments every 2 weeks instead of every month. Do you know what that's all about? And is that still
Sure.
possible to do today?
Sure. One thing that some borrowers don't realize is that any money that you pay extra on your mortgage payment goes directly to your principal. So even if you sent one check in for more than the amount that you owe on your monthly payment, the difference should go to your principal. But if you want to keep track of it, you want to maybe send 2 checks in, and so you can keep better records of how much you've sent. But there are multiple types of payment plans that mortgage companies offer today, and one of those is 2 a month payments. It's not 2 full mortgage payments.
Right.
It's 2 a month, where it comes out to be 13 payments per year, and then that in effect will take your 30-year mortgage. If you do that every year for the life of the loan, your mortgage will be paid off in approximately 23 years.
And people don't realize that by paying additional money, if it's $10 or $15 or $20 a month over and above what the mortgage requirement is, it goes direct to the principal and knocks the heck out of that interest, doesn't it?
Absolutely. Now, I would suggest that before people do that they check with their individual mortgage company to make sure that that is okay, that it's their policy, and the law would protect them to be able to, as long as there's no prepayment penalty,
Right.
And typically there's not in today's mortgage world, that you should be able to pay down your mortgage whenever you want to do it.
Now, some mortgages, you said, have a prepayment penalty clause. If you have say you have a mortgage that's for 30 years or 15 years, and you inherit some money or something, I'm going to pay that mortgage off. Do you get penalized for paying that off on some mortgages?
You don't in the new mortgages that are being generated now,
Right.
but there are some people who are still holding those, there's an important distinction. There are subprime adjustable rate mortgages, and then there are conforming adjustable rate mortgages, which are a 5-year ARM or a 7-year ARM. And these 5-year ARMs and 7-year ARMs were people with good credit took these mortgages because they got a lower rate, and there's no prepayment penalty on these 5-year or 7 on some of them, but on some of these other adjustable rate mortgages, especially the subprime ones with the high interest rates, they have a prepayment penalty where if they try to refinance, they're going to get hit with a pretty sizable prepayment penalty.
That's because the mortgage company didn't anticipate you to pay it off. They anticipated you to pay the long range.
Correct.
All right, now, let's say Irv Homer wants to buy a house across the street. I go to the broker, and the broker says, you're eligible for a mortgage. How do I, as an individual, get my own mortgage and walk into the broker and say, I've got this house pre-approved for $280,000. Can I do that, or are you at the mercy of the broker or the real estate agent, or how does that work? I know that when you go to finance a car, you get your own credit score. You walk into the dealer and say, you don't have to search my credit score. Here it is. Here. Don't go hitting my credit rating.
Right.
How do I, as an individual purchaser of a home, John, walk in? Could I go to you and say, listen, John, I'm interested in a property at XYZ out there. Can you give me an approval on this thing and guarantee me a mortgage? So when I see broker Joe Smith, I can say, I got a mortgage already approved here by John McCarthy of American Independence Mortgage.
Sure, absolutely. Yeah. What I do with customers who call in that situation, I get a general idea of, first of all, what they think their credit is like, and get some income information, and then if they're serious about buying a home, I recommend that the first we do a starting point, and then we run their credit just to make sure that it's where they assumed that it was, and get some basic income information. And then once we have the income information and we've run the credit, we can provide what's called, generally in our business, it's called a pre-qualification. It doesn't mean that the borrower is guaranteed a mortgage. So what we do is they'll shop around for their house, and if they think that they have one in mind, what I recommend to people is before you sign the contract and before you give any earnest money on that property, let me take it a step further, and I can take your information and run it through. It's an automated underwriting system before it's to the actual underwriter, and it's going to kick out either an approval or not. And then at that point, it's not 100% guaranteed, but it's pretty close because it hasn't hit the underwriter yet. But I know that this automated underwriting system is pretty accurate, and I can tell my customer, go ahead and sign the contract and give them the earnest money that you've negotiated, and that you can proceed with the deal.
And we're speaking with Mr. John McCarthy, ladies and gentlemen, of American Independence Mortgage. Their telephone number, if you're interested in getting a mortgage or having your question answered, is 610-388-9788. That's 610-388-9788. And our chat room is available for your questions. If you have a mortgage problem right now, please feel free to give us a chat on the chat room and speak with John McCarthy. I'll read your question to him. He then can answer it over the internet. And we're broadcasting from IrvHomer.com. My website, once again, is www.irvhomer.com. You can email me at evilir@irvhomer.com. And once again, RGH Computer Services for all your computer problems. Their telephone number is 215-322-8685. 215-322-8685. We're speaking with John McCarthy about your mortgage and your possibility of getting a mortgage, refinancing your mortgage, searching for a mortgage, getting the best rate on the mortgage. And what John is going to prophesize is down the future and down the line. John, on these repossessed real estate, how do you get a mortgage for them? Does the bank owns them, they repo them? How does that thing work? And would the same mortgage company write another mortgage on the same property, even though they're foreclosing on it?
Generally not. Generally, it's a whole new mortgage. These bank-owned properties, these distressed properties that the bank owns, you have to be careful because, you see all these guys on TV and on the internet, buy foreclosed properties. They make it sound like
everybody's going to be a millionaire.
Absolutely, yeah. It's not that easy, and you're not always getting the great deal you think you're getting. And the other problem is that the banks are, they want to do the terms of the deal they want to do it on their terms, and they're much more inflexible than a regular borrower, a regular seller, I should say. They want you to do what they want you to do in terms of deal. Don't get me wrong, there are some good deals out there. I just had a customer who had a property appraised at $30,000 higher than the sales price, and she bought it from the bank. But I'm really earning my money on this one, and she's going through a little bit of aggravation herself. So, it's a tough loan, but she's going to come out on the high end.
Once again, your mortgage questions are welcome on our chat room right here at 215-253-8877 is our number, but we haven't quite gotten a three-way conversation going, so I'm asking you to go on our chat room and ask questions for Mr. John McCarthy. John is with American Independence Mortgage. Their telephone number is 610-388-9788. John, what about using your primary residence as equity in buying a second home, say a vacation home, a seashore home, or even investment property. Um, let's say I have a house that's free and clear, and I see a house that I like to buy as an investment across the street. Should I use, in your opinion, should I use my house, the one that's paid off, as
Yep.
equity for the loan, or get a whole new mortgage loan, get a whole new mortgage?
Sure. A lot of people did get into some trouble doing exactly that, over these last few years, where they saw the housing prices going up in value, and they saw their neighbor or their relative making a killing on flipping houses, and just taking advantage of the rise in real estate values. And you have to be careful. You have to make sure that as any investment in real estate, that you can handle the mortgage payments, even when there's somebody not in that property, if it's an investment property, and that if it's a vacation property, that maybe that house will not appreciate in value for another couple of years. But that being said, there are some real great opportunities to purchase a vacation property, either in South Jersey or the Delaware beaches. I mean, I'm seeing some real good bargains for people out there who have the capital in their they have some equity in their home, and they can afford to take some of that equity out and purchase that second home. And you can buy a second home as long as it's considered a vacation property. There's a distinction between an investment property and a vacation property. The vacation property has to be a reasonable distance away from your primary home, and it has to be in a resort area. Otherwise, it's going to be considered an investment property, and you're going to have to pay a higher rate and put more money down. But you can absolutely take the equity out of your existing home and buy either a second home, vacation property, or even an investment property for that matter.
Well, let's say that I have a home that's free and clear, and I want to buy a home across the street as an investment property. Either keep it until I sell it at a profit, or maybe rent it out. Okay? And I found out that after a year or so, I can't hack it. I can't rent it. I can't sell it. And I may lose that house because of a default. Is the home that I have free and clear at risk because I can't afford to pay that house, and they may repo that house?
No, it's not. The house that you own free and clear is a separate contract, separate entity, and if that other house goes into default, I mean, it's going to affect your
credit.
It's going to affect your credit, but no, they cannot touch that primary residence.
See, one of the questions on our chat room is a question that a listener or the viewer probably got from me. It says, does the bank own the property 100% until the mortgage is paid off 100%? If not, can the value be partitioned financially as in a lump sum rebate? No, you can't do it, dummy. I tried it with my bank. I tried it with my taxes, too. I said, since I only own 20% of the property, why do I have to pay 100% of the taxes? And the township...
Yeah, logic would have it that it would work that way, but the banks have had the advantage on us for a long time in that regard.
Yeah, in fact, I said to the bank once, I said, why don't you just repossess the part that I didn't pay on? And I'll saw the house in half, and you can have 2 rooms, and I'll have the other half. But see, this is the illogical thinking of Irv Homer. What can I tell you? We're speaking with Mr. John McCarthy, American Independence Mortgage, and we're getting some good information tonight. Their telephone number, if you can't reach us tonight on the chat room, is 610-388-9788. Ask for Mr. John McCarthy. Tell him you heard him or saw him on the Irv Homer Show, and he'll be more than glad to go out of his way. He works 7 days a week, all night. I mean, this man is just dedicated to the business, to the telephone, and to, to make money. That's what the name of the game is, folks. And when you have the knowledge and the skill and the experience and the connections that John has acquired over the years, it pays to do business with somebody that knows their stuff. What do you see, John, in the future? Is there a positive feeling? And I don't get too political when I have a guest, but in light of the fact, and I don't know whether you're Republican, Democrat, conservative, liberal, it doesn't make any difference to me. As long as you don't do it in the street and scare the horses, it's all right with me. But in light of the new administration and some of the executives order that President Barack Obama signed today, do you think it is going to be good for the mortgage industry, bad for the mortgage industry, good for the buyer, more protection for the buyer, getting the banks to say, hey, we were required by law under the Clinton administration to give frivolous loans to put everybody in a home? Is the business going to tighten up a little bit and be on a positive side? I know it's going to take time, but do you see some of those frivolous loans, that whole attitude changing?
I think in the future we're going to be the legislation with the mortgage industry is going to be continue to get tighter and tighter, and there's only so much money out there for the government to dole out, and there's even been talk about FHA getting losing some of their running out of funds. So that's a pretty scary prospect. But in terms of protect, Obama administration wants to protect the homeowner, but they can only do so much. Just as you said earlier about the promises of the administration, they all sound well and good, and but there's only so much money out there that can go around, and I fear that the job situation that's occurring, the unemployment, it's going to get tougher in the housing industry and the mortgage industry, along with the rest of the economy, and things will be harder to get a mortgage in the future. Maybe you need to put a little bit more money down. Your credit scores have to be up there. So I think things are going to get a little tougher before they get better.
But it doesn't mean to discourage people from still buying property. They still need a place to live. If they have a job, if there's a two-member family income, and you live within your means, the possibility of home ownership under this administration or in the future is still there.
Absolutely, and even though, let's face it, home ownership is good for this country, and the current administration sounds like they want to do things to make people be able to survive and live a good life and have their own home, and if things work out the way that they were presented, then I think that's a goal that's going to be worked towards, and I think people will be protected in that regard. So
we're speaking with Mr. John McCarthy, American Independence Mortgage. Their number 610-388-9788. John, as I drive around, I'm sure you do too. You're on the road a lot, probably seeing clients, seeing customers, looking at properties. I see a lot of these 55 and older communities, and I see a lot of, quote, condominiums. Are they mortgaged? I mean, when you buy one of those things, do you get a mortgage on a condominium, or is that a different type of financing? Give us some insight into the condominium buyer or the senior citizen listening to the program who is 55 or older and says, you know what, I'm tired of cutting grass and I'm tired of shoveling snow, and I'm going to go into a condominium, and then maybe the condo sells for $350,000, and I'll put $200,000 in from the sale of my home. What type of mortgage do you get on these things, and what kind of restrictions or requirements do they deal with?
Yeah, the Fannie Mae, Freddie Mac, and FHA, they're really getting kind of tough on condominiums. They consider condominiums a higher risk endeavor than they would like a regular like a townhome or a row home. To compare it to something like that. Condominiums are just harder to get approved. They're harder to sell. Definitely as an investment property, I would today stay away from. It's just it's in a niche right now that is not held favorable among the people who wind up buying or insuring the mortgages. And but there are a lot of 55 and older communities out there that are the value is there. You pay your homeowners association dues more than most likely that's going to come with the property. I would, if you're going to buy a condominium, I would buy one that's already developed and not something that's like the fifth phase out of 5 more phases to be built, because the mortgage companies don't like that kind of scenario. Buy a completed condominium development and one that has a solid homeowners association. The homeowners association is run by the homeowners association and not by the builder, because that's a bad scenario as well. But there's plenty of them out there that are a great deal. They have clubhouses and they have pools and recreational facilities. There's some great deals out there for 55 and older borrowers.
When I bought the property that I'm broadcasting from, it was a distress sale. And the distress sale was a domestic problem that they were in the middle of divorce. And there were 2 mortgages on this house, John. Mm-hmm. What? I didn't care about. I said, look, this is the house I want, and I bought it. But what is a second mortgage? How do you get? I don't understand that.
Yeah, a lot of people don't understand that when you get a home equity loan or a home equity line of credit, they're 2 separate types of loans. Anytime you go to your bank and you get one of those, that's considered a second mortgage. So that mortgage, that loan that you get from your bank, if it's a home equity loan or a home equity line of credit, it's a lien against your property. So it's considered a second mortgage. The first type of loan from the bank, a home equity line of credit, is an open line of credit that you can either take all at once, or you can take some of it out and then leave the rest of the line of credit open for later, use later. And that's usually an adjustable rate. So you start out with one rate. If the rates go up, you gotta pay that higher rate on the money that you took out on that. The second type of loan is a home equity loan. It's also a lien against your property, but it's a fixed rate, and you know how much you have to pay. It's a fixed amount and it's a fixed rate. So, but those things have if you sell your house or refinance, depending on the situation, you may have to pay off that second loan to get a new loan, or you can do what's called, you can refinance and you can keep that second mortgage alive and do what's called subordinate that second mortgage and keep the second mortgage and just refinance your first. If you like that second mortgage, maybe you have a real low, good rate, you keep the second mortgage and you can just refinance your first mortgage at a lower rate.
We have another question for John McCarthy. John, can I remortgage from 6% to 4.854% from a 30-year to a 15-year right now? Should I do it since I'm going to live in the house for at least 3 more years? Do you see the rates going any lower?
And that gentleman owns 65%.
Oh, and he owns 65% of the property right now?
Yes.
Yeah.
Okay. Yeah, that sounds like a pretty good deal. You need to, of course, the 15-year mortgage is It's going to give you a higher payment because you're paying off the mortgage in a shorter period of time, but it is a much lower rate. So what you want to do is take a look at the amount of money that's going to cost to refinance. That is your closing cost. You take that amount of money, and then you look at the difference in your monthly payment, and you subtract your current monthly payment from what your new payment's going to be, or vice versa, I should say, and you see the difference of how much you're going to save each month. You take the total amount of your settlement charges, and you divide that difference and see how many months or how many years it's going to take you to pay that or to break even. And it sounds like you said you're going to be in that house for more than 3 years, so most likely if you're in that house for more than 3 years, it sounds like you'll be able to break even, and from that point on, those savings will be to the plus side for you.
Good stuff. Thank you, sir. We have a hypothetical question on the chat room, but dealing with hypothetical questions is something that I do in an open forum. It isn't something that you deal with someone who is in the business. They don't set and regulate the business. They just explain what the business is. So I appreciate your question on the chat room, but we can't deal with hypotheticals. John, when you take a mortgage, there is mortgage insurance. I want to take a mortgage for $200,000. I want to make sure that if I die, my wife and the kids get the house, and I want the mortgage to be paid off. Does it pay to get mortgage insurance when you get the mortgage, or does it pay to get life insurance from a private insurance company and pay the premium in the event that I croak or the person croaks, the house is paid off?
All right. Yeah. From what I've up to this point, from what I've seen, what I've read, it seems as though it's better to get the life insurance than the mortgage insurance. And the mortgage insurance, it should not be confused with PMI, which is private mortgage insurance. That's what people pay when they have 20% equity, less than 20% equity in the property. What you're talking about, Irv, is if someone happens to die, the mortgage gets paid off for the
Right.
people who are left.
Right.
Yes. And it appears to me that getting a regular insurance policy, like a term life insurance policy, has a lot more value than in terms of rates than getting mortgage, pay off your insurance to pay off your mortgage in case you're deceased.
Now this is the mortgage question, but there are a lot of, and I had it, and I know it, I had not death insurance, but I had disability mortgage insurance in the event I lost my job through some type of disability or illness. I had insurance with a private insurance company that would pay for the mortgage of this stuff. They wouldn't pay it off, but they would reimburse me monthly for the amount of money that my mortgage was. And then they also added that if I could change the rate, or they had the invasive ability to go in and see the lowest rate I could get. That was a good deal, I thought.
Mm-hmm. Yeah, I guess you get these opportunities that come your way, and sometimes it seems like a good deal. I would just usually if you're sticking to basics and just stick to the basic product, it's there for what it's presented there for. A plain, just to check out a plain old disability policy that you can expand on. Maybe you pay a little bit more each month, but maybe that disability payment or part of that payment will pay for your mortgage. So I guess it's just like anything else. You shop around to find the best deal, and how much you're paying per month, and what that insurance is actually covering.
Now, a lot of people do not know what an amortization table is, John. And for the first house I bought, I had a $30,000 mortgage. And they gave me this amortization table, and I said, boy, that looks like a lot of numbers. And they said, well, this is the 30-year amortized debt that you have. And I looked at what I paid for the house and what I was going to end up paying for it if I went it out 30 years. I said, holy moly, that's a long stretch there.
Mm-hmm.
Now, after I made the joke, and that amortization table was a godsend to me because it went back to what we said earlier. Every time I made a little bit of payment on the principal of that loan, that thing went down.
That's right. That's right.
So
it's always good for people to take a look at their own individual amortization table, because for every loan, every amount of money, it's different. So it's good to take a look at that because, as you said, we talked about earlier, you can imagine your amortization table as a ladder. And each payment that you make moves you up one rung on the ladder for 360 payments if it's a 30-year mortgage. If you pay extra towards that principal, you could move up 10 rungs at a time as opposed to one, so that the principal amount gets cut down shorter and shorter, and so that 30-year mortgage could turn into a 20-year or a 25-year or whatever you're comfortable with in terms of your ability to pay it down.
The question on the chat room is something that I'll answer, John, if you want to add to it. Your mortgage principal is being reduced each month. Why would you insure a $90,000 mortgage when you only owe $60,000 5 years later? Well, you would pay off the $60,000 and have 30 grand to the good. Or you could take out another term policy for 60 grand. When it gets down to 30, you take out a term policy for 30 grand. It doesn't mean that you're going to, the mortgage, the insurance principal doesn't diminish with the equity that's left in the property. It's an insurance policy that you keep aside to pay the mortgage off. Am I right, John?
Absolutely,
right.
Absolutely.
So yep. I can understand where the caller may have got confused. John McCarthy, it's been a fast hour. I'll tell you one thing, it boggles my mind sometimes when you get involved in this kind of stuff.
It's a fast-changing world, and it's a fast-changing business that I'm in.
Well, you always have an opportunity to come on the Irv Homer Show. If there's anything interesting or informative for our listeners or viewers, please feel free to get in touch with John or get in touch with me, and we can do this again. Our guest has been Mr. John McCarthy, ladies and gentlemen, American Independence Mortgage. Their telephone number is 610-388-9788, 610-388-9788. And if you need any type of honest dealings, I know this guy. This guy is so honest, he nauseates me. He really does. I mean, I'm used to dealing with some really sleazy. John, it's an honor to know you. It's a pleasure to know you. And thank you so much for giving us an hour tonight.
It's my pleasure, Irv. I enjoyed the whole time.
Thank you so much.
Thank you.
Once again, we've been broadcasting from IrvHomer.com. The website is www.irvhomer.com. You can email me at evilirv@irvhomer.com. This has been brought to you by RGH Computer Services for all your computer problems. Their telephone number is 215-322-8685. 215-322-8685. On Friday night, ladies and gentlemen, I guarantee you, I will beat up on this administration so bad, you'll swear that Dick Cheney is back alive and well and that George Bush never left the White House. Also, I'm going to take on some of the bloviators, and I'll just make a real fast comment tonight on the comments that I heard from Rush Limbaugh, that I heard from Sean Insanity, and I heard from Dingleberry Medvid. These guys, I have come to the conclusion as I was driving to my radio program today, these guys would tear apart the Sermon on the Mount. So Jesus, if you're thinking of coming back, don't give that sermon again, because I guarantee you the next day, Insanity Hannity would tear it apart, Limbaugh would have another OxyContin fit, that Mike Gallagher would think he's a mental genius when he's really a mental midget. I'm Irv Homer. We'll see you on Friday.